presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak Asset Management YouTube update for June the 27th, 2023. I'm Mo Ansari, President of Compak Asset Management and host of Market Wrap. You can get the daily edition of Market Wrap every day simply by going to compak.com/media. There you have all the information. You can download the app to your phone where you can get the daily broadcast that I do every day, 1 hour, and we have some great guests there also. You can also come and get the weekly newsletter that goes out. It's just a one-pager just to keep you updated. And whenever you get an update on YouTube, make sure you select the subscribe button. So whenever I do one of these updates, you will get notified and you can come. So all of the information is there. I'm going to talk a little bit about the Fed, a little bit about the market, the economy, look at technical analysis, and then look at the week ahead. So let's start with the Fed. We had the Humphrey Hawkins testimony, as it's called. Twice yearly, the Fed chairman of the Federal Reserve comes in front of Congress and lets them know what they're thinking, what they might be doing. What he basically said is that they are going to raise interest rates 2 more times. The probability is they're going to raise rates in July by 25 basis points, and that's about a 75% probability in the futures market on the Chicago Mercantile Exchange. That's what it's predicting. Now, those change every single day, those odds, and they can change dramatically. I'll talk about that in a second. Also, there's a 25% chance that they're going to raise interest rates in September again by 25 basis points. I think inflation is coming down. We are going to get an inflation number, the CPI number, before the July meeting of the Fed Open Market Committee. And if that number is down like it was from 4.9 to 4% for inflation last month, if it comes down somewhere in the low 3s, I think it might give, again, the Fed some room to pause. We are starting to see some unemployment starting to go up. The claims for unemployment hit a 21-month high. That's what we're seeing. The claims are starting to go up. More people are asking for unemployment. That means the labor market is starting to loosen up also. And if unemployment starts to go up, there'll be a lot of pressure on the Fed to stop raising interest rates. The Fed does this. They go overboard. They went overboard by keeping rates too low, too long. Now they might go too high, too quickly. That's what might happen, and they might break something in the process. The Fed does not want to do that. To engineer a soft landing, I think they're going to be hawkish. You've heard me talk about that in the broadcast, where they say they're going to be not hawkish, that's when they raise rates, not dovish when they lower rates, but hawkish, where they're going to talk a tough game and say we want inflation at 2%. But inflation running at 3%, they might just tolerate it and continue to say, just like they did with unemployment. If you remember Bernanke, a few years ago, he said, unemployment goes below 6%, I have to raise rates. We are at a 50-year low. Nobody talks about unemployment being too low. And that is the same thing, I think, with inflation being 3.5%. The Fed will let it go. That's my thinking. But these are the projections, the dot plot. The Fed thinks that they're going to get to 5.6 as a peak. We'll have to wait and see. When Fed peaks, they tend to peak rather than plateau. That means they go up and then they start bringing rates down. Because what they usually do is raise rates too much, economy starts to go into a recession, everybody says, oh my God, the Fed says, oh yes, let's bring rates down to stimulate the economy. Again, I think this time the economy is going to continue to muddle along. It's not going to go roaring, but it's still not flipping over into a recession. Everybody has been talking about this recession for the last year and a half. It's the most advertised recession we've ever heard. The market went into a bear market expecting a recession at the end of last year. It didn't happen. Then everybody said it's going to happen in the first quarter of 23, second quarter of 23. Now they're saying it's going to happen in the second half of 23. I think economy is going to slow down. The impact of interest rates are there. We're seeing the housing numbers came out. They're better than expected. Economy is going to continue to muddle along as long as unemployment is low. People will continue to spend. 83% of our economy is consumption, is services. 17% is manufacturing. Manufacturing is already in a recession. We've slowed down in services down to 50, below 50 on the ISM number says that area is contracting. We haven't seen that yet, but I think we're headed there. But as long as people have jobs, they continue to spend, and they say, look, as long as I have a job, I'll pay it off, put it on my credit card. And that's why we are going to continue to see consumption, and that will hold up the economy. As soon as unemployment goes up, that's when we see really the economy slowing down. Looking at the markets, technology has done incredibly well this year. It is up about 40%. Everybody now, what happened to crypto? Everybody forgot about crypto. Now it's AI. That's the big thing that everybody is chasing. Let me buy some AI, I'm going to get rich. Having a diversified, balanced portfolio with the right goals. That's what you have to get done first. Why are you doing what you're doing? First, you have to figure that out. You have to have a financial plan done by a financial planner, 80-page plan that gives you all the details of where you're headed, what it's going to look like when you get there. Once you have your goals, you say, okay, this is what I want. I want this for retirement. I want to buy another home. I want to send the kids to college, whatever it may be. That's what you do, that you set up those goals. Then you look at your risk profile. How much risk can you handle financially and emotionally? You marry the two and come up with a risk number. Once you have the risk number, you have your goals, then you find a portfolio that matches that risk number and those goals. That's how you go about investing, not buying this one stock and chasing it up, chasing it down, and up and down and going nowhere. Communication service sector, energy, last year was the darling. Oh my God, we are going to run out of oil because of the Ukraine war and so on. This year, it's the worst sector, but that's how everything goes in sectors. Looking at the economy, year over year, core inflation is still going up. We have to have that coming down. We get the PCE, as it's called. That's the Personal Consumption Expenditures Index. I know it's a mouthful, but that's what the Fed looks like. It's a core. That's what they look at. That if that starts to come down, the latest number is 4.3. We get another number on Friday. If it's below 4, that would be good. So we'll have to wait and see. I'm going to do a seminar in San Jose. If you want to come and attend, make sure you go to compak.com right there at the bottom of your screen. /seminars, and you can register free. And then I'm going to do a live webinar on August 8th. Looking at the technicals, this was my target, 4450. That's a projection from here. This is a Fibonacci projection, and it's between 4450 and 4530. Well, we got to 4450, touched it about 2 weeks ago. Now support is at 4320, which is the 20-day moving average. We came close to it yesterday, had a big day up today. I think if we break that, then we can come down to this 50-day moving average, which is about 42.10 or so, and that'll put us down about 5-6% in the market. That's what usually pullbacks are. Pullbacks are 5 to 10%, 10% or more are corrections, 20% more are bear markets. I still think we're in the summer months where we are going to see a lot of volatility, back and forth. Once we get into July, everybody will start saying, oh my God, here the Fed is going to raise rates. Also, we're going to get earnings, which I think might come out better than expected for the second quarter of this year. Those are going to be reported in the first couple of weeks of July. So we are going to get a lot of data over the next couple of weeks, and that'll really determine what the Fed will decide. If the unemployment numbers are going up, if inflation is coming down, the Fed might say, well, we've done enough. And as soon as the market gets the indication that they've done enough, I think that will make the market move higher. Looking at the weekly charts, support still around this is the long-term target at 46.37. I don't know if you heard Sam Stovall yesterday on the broadcast. He is the head of CFRA Research. He was the head of S&P for 27 years, head of research there. So he was on. They've raised their target now, CFRA Research, to 45.75 as year-end target for the S&P. Are we going to get there? We'll have to wait and see. But if we do get above that 45.30 area, which is the Fibonacci retracement that I was just talking about right here, this number right here, that's the band that I talk about. If we get above the top of it, which is 45.30, then we could accelerate to the downside. I think this summer we can bounce around here and go back and forth. Looking at the Nasdaq, again, target was 13,650 to 14,000. Again, Fibonacci projection from this high. That's the numbers we got. We hit that right, we got to 13.8. That was the high right here that we saw, and from there we've come down. We touched the 20-day yesterday, bounced back up today, major support 50-day if you break the 20-day, which is 12,700. That will be about a 1,000-point drop in the pullback in the market and the Nasdaq. I think, again, if we get those over the next month or so, I believe those are good opportunities. Weeklies, this is the dot plot as long as the market, this is the vertical lines of the market, this is my dot plot. As long as the market is above the dot plot, is it bullish? Here it was bearish, here it was bearish. It was bullish for a few weeks right here and then turned back down again, which doesn't happen that often. But it's been, this is a weekly chart, and that number is 11.8 before we turn down again. So I think we're a long ways away. We're sitting at 13.5 today, big up day, target here. And then if we can get above here, then we're looking at about 14.6. That's the 14.650. That is the high that we made right here. That was March of last year before we came down. So we'll have to wait and see. Interest rates stuck in a broad range right here, 4% to about 3.3%, just going back and forth, not going anywhere because the market is not quite sure how. I think interest rates peaked right here in October of last year. That's when the market bottomed also. Gold market, as you heard me say, 2085 was a high. That was a fifth wave top. Now we're starting a wave count, not an ABC, but a 1, 2, 3. We might get a fourth wave bounce, but that's a selling opportunity. Resistance 1960, the 50-day moving average. Resistance right here, 1986, 50-day moving average. But I still feel that we can come down to the 200-day down here, which is 1857. It's moving higher. I think 1875 to 1900 would be a number that I would be looking for in gold. That'll be about a $300 drop from the high. I think that would be a good enough place to take a look at gold. Those are my thoughts. Those are my views as of June 27th. Have a wonderful week, and I will see you in the next few weeks.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.